going through this sim. This is not a very difficult sim. If you're able to, so I've given you 3 graphs here. This is a classic application of a box and plot diagram. And I've kept it simple. Okay, what I'll try to do is I'll try to give you these small sims that helps you understand the concept. And I'm trying to introduce the questions of audit to you in layers so that you're able to understand how do you interpret the graph and how do you answer the questions from there. Okay. Please participate, everybody. And I'm going to put you questions. I want all of you guys to answer those questions. Okay. You are auditing Urban Retail Corp, which is a chain store specializing in durable consumer goods. The gross margin percentage is traditionally stable at 35%. So you're a retail company, you're taking the audit for that, and they are into consumer goods which are not perishable. And generally, they operate at margins of 35% of gross margin. That means if the sale is 100%, then the cost of goods sold is 65%. Based on a moderate risk of material misstatement, you have designed a substantive analytical procedure to test the accuracy of COGS and valuation of inventory. So what you're doing, you've already assessed the risk of material misstatement. And depending on that, now you're performing substantive. What kind of substantive test? Analytical procedure. And what you're trying to do is you're trying to figure out what is the accuracy of cost of goods sold and how much has been the inventory valuation. Is it over or undervalued? The ADA disaggregates GM percentage by sales channel. Okay. So you take the first exhibit, they've given you some data. Then you take the second exhibit and you get a monthly data. And then you have the third exhibit where I have 4 different sales channels. Okay. So the ADA disaggregates the gross margin percentage by sales channel. You must evaluate the implications of the identified outliers and the variances in the distribution. So I see here so SAP here stands for Substantive Analytical Procedures. So why did you design this test? What is the meaning of the data that you're going to see here? What are you going to investigate as a result of this data? And how do you figure out how much reliable is the data on which you're working? And on what basis are you going to develop the precision of your estimation? These are the 5 different questions that we're going to answer from each one of these exhibits. Okay. So they are saying that the total sales revenue for the general ledger is a predictor. So I'm looking at the total sales in my general ledger. I know that my gross margin percentage is 35%. So I know that my COGS should ideally be 65% of my sales. Analysis is disaggregated by sales channel to improve the predictive precision and identify specific risk classes. So what we're doing, we're looking at a sales in the P&L. From there, we're trying to figure out how much should be the COGS, how much should be the inventory. And then depending on that, we're trying to figure out what is the actuals. And then we're breaking the sales into 4 different channels to see if we can make out some idea about where are the areas where the risks are there, so that we can identify those risks. Great. So here I look at the monthly trend of sales. Okay. And I know that March, June, December, these are the months in which the sales was high. On an average, more or less, I know that my gross profit percentage is also, I know that on an average, so this is a GP percentage, like on an average, my sales have given me a margin of 35% over the year. So I'm not wrong in assuming that my COGS should be 65% of sales. So this is my gross margin percentage trend analysis. So I know that month on month, maybe there's a push here and there, but month on month, I can assume that they have maintained a 35% gross margin. Okay. Now I look at the GM percentage distribution by sales channel. Can anybody read this graph and tell me what is it that I have to be worried about if I look at the chart? Because see, the first and the second have not shown me much data here. Okay. The first and the second have not given me much data here. The third exhibit, can anybody tell me what am I going to interpret in this data? Anybody? This is just the gross margin percentage distribution by sales channel. Can you tell me what would you infer from this data? Raise your hand, write in the chat panel, but please answer the question. Yes. Channel C is dragging. So channel C is actually showing you a much less gross margin percentage. Okay, very good. So one thing is very clear, the channel C is pulling down a gross margin. But if you look at it, channel C is actually giving you somewhere around a lower one, right? And also very good, Shikha, that we have some very big outliers in channel C and channel D. Okay, Shikha, unmute yourself. Which
Yes,
will
ma'am.
be a cause of concern for you? If you have to drill down further, which are you going to drill down more on, C or D?
Ma'am, I'll drill down on D because overall the average gross margin is lower than the average, but there is one outlier which is way above.
So you will, okay, I'm asking you a question. Will you prioritize channel D outlier or channel C outlier? Or
Ma'am,
both?
channel D, I mean, obviously both, but if I have to choose between one, it'll be D because my risk is overstatement of sales. So,
So I know in this case, suddenly I'm having a 60% gross margin. And also in this percent, maybe I'm offering where, so channel C, there'll be a risk of related party disclosures. Yes or no?
yeah,
Channel D, there may be a risk of, so channel D, there may be a risk of, I don't know, suddenly maybe some error actually, isn't it?
yeah.
Because how can suddenly you get such a huge profit from the market? Maybe it's a wrong entry that has been made. But channel C is a big problem. Why? Because this clearly shows that you've given a huge discount to somebody who may be a related party. So both of them are important. Okay, nobody spoke about channel B. There is no risk with channel B, guys. Is there a risk with channel B? Yes, no. Nobody spoke about channel B. Why? For me, channel B is the most risky channel because suddenly, if all your channels are showing you a gross margin percentage of 35%, suddenly I have a channel that is giving me a gross margin of percentage of maybe 50%, isn't it? Way more than 35%. So what's happening in this channel? As an auditor, I'll be more interested in figuring out what's... Can you understand the graphs now? Channel A is the safest. It is conforming to my norms. It is a small box, so I know most of the sales have been happening at 35% margin. There are no outliers. So channel A is a channel that I'm not going to talk about. Are you able to understand what is the meaning of this bus? What is the meaning of this whisker? And what is the meaning of the size of the box and the median value? So channel A is like, a good boy in my class. I'm not going to talk about him. But channel D is again, it is near to 35%. That's a good thing. But then can you see here, the data is spread across, right? Channel C is again more or less consistent, but channel C is showing me a very strange. So channel B, C, and D, I'm going to drill down further, okay? 5 more minutes. And now, very clearly, you get only one chance to get the question correct, guys. Okay. The questions are not going to be very easy, and the answer choices are going to be very, very confusing. So go slow and then answer me the questions. Okay. So when you're doing this box and visco plot diagram, the substantive analytical procedure models reliance on predicting COGS using a stable GM percentage directly tests which primary assertion for both your COGS and your inventory. Which assertion are we concentrating on, guys? Look all the four and then give me the answer. Which assertion are we concentrating on in this example? Try to answer. I'll take time, but answer correctly. The first question, which one are we trying to do? Negate the answer choices. Don't choose the right answer. Negate the wrong answers, okay? What is the answer for the first question, guys? A, B, C, or D? Naman, you have to write one and then give me the answer choice, okay? Uh, okay. For those who have answered, okay, everybody, I want everybody to answer. Guys, it's very important that everybody should answer the question, okay? It's important to get it wrong, because then if you answer, you will never get, that learning will never go away from you. Okay, so we're talking about COGS, which is a cost element, and an inventory, which is actually the risk is of overstatement. Can you understand? Okay, for those who answered C, Naman and Kai, both of you, can you understand that C is only talking about COGS? They're not even talking about inventory. But in the call of the question, they've clearly said that by analyzing my GM percentage, we're trying to check both the valuation of your COGS as well as the valuation of your inventory. Now, all of you, can you understand that you were able to negate answer choices 1 and A and D you were able to negate? When I'm choosing between B and C, obviously B is a better target for me than C. Why? Because C does not even talk about inventory. But B talks about accuracy and valuation that automatically takes care of the dollar figures that are going in both in the P&L as well as in the balance sheet, correctness of COGS, and the inventory cost of the NRV. So it is already taking care of all the details here. So, Naman, do you agree?
Ma'am,
Naman,
but looking at the graph, how can we?
we are not looking at the graph. When we did this, the call of the question is what? Before you started doing this idea of taking sales, understanding that since it's retail, then you know that there's a stable GP percentage, and then you're trying to figure out what is COGS and inventory. Which assertion did you start with? The assertion will precede the result of the graph, isn't it? Naman,
Yes,
this is what you thought, and that is why you did this diagram, or you analyze the data like this in order to understand the anomalies and concentrate your further audit procedures on this. Yes or no?
correct.
So which assertion did you start with? It was not only COGS, it was COGS and inventory valuation, isn't it? And it was not just the existence, it was also and first of all, COGS and existence was not going together. It was also, who told you it's only that you're talking about fictitious transactions? Ideally, COGS would be understated rather than overstated, isn't it?
Yes,
So in this I know is wrong, isn't it? See, this only talks about COGS. COGS, even if it will use the word occurrence and not existence with it. Yes or no?
mm-hmm.
And there also the primary assertion would be understatement and not overstatement. So ideally, you should have thought about completeness for COGS and not existence for COGS. Do you agree?
Yes,
So this is theory. We are not still correlating it with the graph. We are relating it with the approach. Have you understood?
okay,
Are you convinced?
yes.
Kai, did you understand? Where was the anomaly in your thinking?
Yeah.
Hello? Are you able to understand? Kai?
Yes.
Okay, now you go to the next question. The high median gross margin percentage in channel B, which is very high compared to the trend, most strongly suggest which risk of material misstatement. Now we are coming back to exhibit 3. The fact that channel B has high median gross margin percentage, and now they've given you the figure, which is 48%. What do you think could be the risk out of these four? Negate the wrong answers, guys. Don't choose the right answer. Negate the wrong answers. What is the risk if you see a trend like this is happening? Then for you as an auditor, what is the risk that you're looking at? What is the answer for the second question? Look at all the 4 choices. Please write 2 and then give me the answer. I would not know which one are you answering. Write 2 and please do not look at the answers before you answer. If you look at the answer and then you're taking a wrong approach, guys. Garvit, I don't know how you are answering. What is 4 and then A and then 2? I don't understand the 3 terms that you're mentioning here. See, If my GP percentage is high, that means my COGS is low. See, understand the relationship. If my sale would have been 100, and if so my general trend is 65% margin, so my COGS should have been 65. If this becomes 48%, that means my COGS becomes 52. And a lower COGS means a lower COGS means a higher inventory, isn't it, guys? What is not sold is going to be put in inventory. So negate the wrong answer. COGS is overstated is wrong. Revenue is understated is irrelevant. I know this cannot be the right answer. So I know A and C are wrong answers. The moment I look at this, immediately I know that A and C are wrong answer choices. Now the choice is between B and D. Inventory is overstated because COGS is too low. This looks correct. Inventory is overstated due to failure to recognize obsolete stock. We don't know this. This data is not available to us. Hence, the answer for the second question is going to be B. We cannot tell you what question you will exactly get. But ideally, you start the ADA with an assertion. You should be aware of what that assertion is. Then when you perform the audit data analytics and you get the results, you should be able to understand, because of that result, what is a primary risk that the auditor is looking into. The risk here is that your COGS is understated. That means your inventory is overstated. That is the risk. Now you go to the next one. What would you do now? Corroborative audit procedure. Now, after you see this, what is going to be your next step? To confirm the 48% gross margin outlier in channel B, the auditor should inspect the sales order for improper price increase authorization. Now, this is a very good question, guys, okay? Please go slow. Try to give me the right answer. To confirm a 10% gross margin outlier in channel C, that means when you're confirming, so you have to confirm B, C, and D. They're trying to correlate the risk with the procedure. What are you going to do next? Okay, is the first one correct? Would you do that? If you want to confirm that this is, so we know that there is no outlier in channel B. There is no outlier in channel B. So I know inherently A is an incorrect answer. To confirm the 10% gross margin outlier in channel C, the auditor should inspect the related COGS posting for evidence of improper valuation. To confirm the 10% gross margin outlier in channel C, this particular outlier in channel C, the auditor should inspect evidence such as markdown advertisements or sign-offs. And to inspect a 48% gross margin outlier in channel B, the auditor should inspect shipping documents for quantity matches. Which do you think is the right answer for question 3, guys? Okay, what is the correct process that you would be using? A, B, C, or D? Everybody's answering B for, okay. Unmute any one of them. Vishnu, unmute yourself. Explain what are you going to do in B?
Oh, okay. See, I mean, there is a 10% margin in channel C.
So
So I
this
would,
one, basically you are trying to figure out this dot, right? Why
yeah.
has it gone to 10%? Okay.
Yeah. So that means like one of the product in C is at 10%, right, ma'am?
No, this means, see, ideally when the margin is low, is it because
Yeah.
the COGS is low or is it because the sale is
No,
low?
no. I'm asking about the outlier. The outlier means maybe one of the product.
One of
falling.
the sales must have been made at a very low, at a very low gross margin. Have you understood?
Mm-hmm.
Have you
Okay.
understood what I'm trying to say?
Yeah. But so
Now,
I suspect
ideally,
one
people
of
cannot
that error.
camouflage. Yeah,
Yeah.
sorry.
I suspect an error in COGS posting for that one occurrence. Uh,
No, but see, in life, in real life, you will see, ideally, see, you are doing a channel-wise analysis for the sales, right?
hmm,
So that means you're looking at the sales data. Have you
hmm,
understood? And from the sales data, you're trying to interpret what would be the COGS, and then you're comparing the actual COGS with the prediction of COGS. Yes or no? This is what you're doing, isn't it? I'm
no, I'm
looking
not getting what you're saying,
see,
ma'am. We
I'm
have the
looking
sales
at
and
sales.
COGS. Yeah.
So you have predicted the COGS by looking at the sales, right?
No,
That is why
real time we don't do that because COGS is posted at the time
no,
of
no, no, no,
sale
no. I'm
based.
saying as an auditor, what have you done, Vishnu? As an auditor, you have looked at sales and then you
Mhm.
have anticipated that your COGS should have been 65 if my sale is
Okay.
100. Yes or no? And
Yeah.
then you are comparing your actual COGS with your anticipated COGS. And
Mm-hmm.
that you are doing channel wise to understand where is the delta. This is the method that you are adopting, isn't it? That is why you have said that ideally it should be 35, but these are different, so I need to know where is the anomaly, isn't it?
Yeah.
So ideally when companies show a very low gross margin, they don't twinkle with the COGS, they would twinkle with the sale prices, isn't it? In
Yeah.
real life,
Because
suddenly
of
the margin goes down. the
yeah.
most the most expected details is either you would have offered a huge discount or maybe a huge sale must have happened to liquidate the stock through this channel, maybe, isn't it? In real life, how can you go and do a COGS wrong booking in the books? That the chances of that happening is way less than the chance of a special discount or a sale being given to liquidate that stock.
Yeah.
No, it is not about the channel, Naman. Are you understanding what I'm trying to get at? Had this been for the full channel, then I would have understood there's a difference. COGS entry for a particular sale, a sale is not linked to a COGS particularly. Like COGS entry you pass. Now, they have not told you that this is a periodic or it's a perpetual inventory system. But COGS happens independently and sale happens independently. Yes or no? Vishnu, I
Correct.
want to understand. Naman, see, this is a particular item that is happening in a particular channel, right? So this is one sale that you would have, that maybe you could have offered at a very low discount. Maybe that is the most likely reason. A
Okay.
COGS, unless you, okay, if you guys answer COGS, then you are assuming that it is a periodic inventory system, but that is not what is given to you anywhere. Vishnu, do you agree to what I'm saying? Why would you assume that COGS entry is going to be passed after every sale? Or it will not be passed after every sale?
Uh,
COGS.
no, I'm not assuming that, ma'am, because in the real life, even in the inventory, if it is a perpetual inventory, there are chances of errors due to how the uh you know invoices are, I mean, receipt and receipt prices are being booked. But I agree with you. We normally check the selling price that is more evident than
Then the
digging further
COGS. Only if you don't
into
find anything wrong in the selling price, then we go to COGS
it.
testing.
Right.
Right?
Yeah.
So the
Yeah.
first step, if you look at, is actually the sales rather than the COGS. Okay? One second. How many of you could not understand what we've discussed? In general, what we are looking at is a Rashri, unmute yourself. See,
Yes, ma'am.
suddenly there has been a one outlier where the gross margin has been 10%, where the average ideally, in even in this scenario, the average must be somewhere around 17-18%. But in that channel also, there was a one particular instant of sale where the gross profit is 10%. Okay? As an
Yes.
auditor, what will be your first thing? That you offered a huge discount to this party for the sale. Yes or no?
Yes, but I thought that because my COGS is low, my inventory, that relation I started thinking.
No, no, that relation is correct. But the question here is concentrating on COGS, isn't it? Okay. What I'm trying to say is, no, but what are you thinking, Rashi? I still don't understand.
Yeah, because the gross margin is low, that means my COGS is overstated. That's what I thought.
Okay, no, but you have to look at the practical aspect now. Yes, my COGS is, your COGS is overstated. No, you cannot say it is overstated. See, what I'm trying to say is maybe this 100 came down. You never know, right? Why will you assume that the 100 remain 100 and my COGS was high? You would not assume that, right? Have you
Okay,
understood what I'm
sales.
saying? You
Yeah,
are
about the
assuming
sales.
that this 100 was 100 and
Yeah.
COGS should have been 65, but this COGS has become 85 now. This is what you're assuming,
Yes,
right?
yes, yes.
That may not be true. That maybe that your sales had come down. You never know. Have you
Yes, I
understood
think
what I'm
that
trying
the
to say?
sales constant actually.
But ideally, in real life, whenever there is an issue, the first thing that we want to check up is, was there a heavy discount given on a sale? If that is ruled out, then we go to COGS, because actually doing this for a particular item of sale would be an error. It will not be a fraud. But reducing your sales price without proper authorization may be an area of fraud, or maybe a related party transaction that has not got unnoticed. So that for an auditor is more risky than this. Is that clear? Because
Yes,
if it is a COGS issue, it may be an error. And ideally, we don't start leaping on COGS immediately. Okay? So the
yes.
answer for this becomes C.
And ma'am, what do you actually mean by markdown advertisements or sign-offs?
So it's like bulk sale. You have given bulk sale, or maybe you have given a huge discount. You never know that, right? So we will figure out, why is this 10% so down? So my first immediate reaction would be to see. So markdown means sale price has been brought down because of some kind of a sale initiative. That may happen, right? My old stock, I just gave it at a huge
Yes,
discount. Possible, right?
yes, yes.
That is what we are looking at. Okay. Next question. Data reliability evaluation. If the auditor relies on the cost data from the perpetual system, which condition was most likely decrease the reliability? So I'm looking at the perpetual inventory system. I'm looking at the cost data from that system, and now they're telling me which of these would reduce the reliability of your data. Can you tell me? Read very slowly and then answer the question. Which of these will, so I'm following a perpetual inventory system for costing. I'm looking at that data, but what is it? If it were to happen, then the data that I'm processing becomes unreliable. Maybe the chances of reliability on that data decreases significantly. Can you tell me which of these three seems to be the correct answer? The COGS is calculated based on monthly data aggregation instead of, this will not, just because it is perpetual and they're doing it on a periodic basis, will not make it less reliable for me. Rashi, you'll have to put in a little bit more effort in doing this, okay? Go slow. Ineffective IT controls over access to master inventory records. If anybody can come and make changes in the inventory data, automatically the data that I'm looking at is not very reliable, isn't it? It is not very reliable. Okay? This is also a very good question. See, which factor determines the required closeness or precision of the auditor's expectation in an substantive auditing procedure? That means, depending on which factor will my expectation of 100 or 35% will change. Like, how close would I want my expected result and the actual result to be? Like, this closeness of my actual result to my anticipated result. In which scenario would I want it to be closer? Look at the fifth question and give me the answer for the fifth question. Where would I tolerate? Where will the gap be reducing between the anticipated and actual result? If my sales, if I'm doing 100 transactions compared to that, if they're total 120 transactions, will I want a more proximity? Will the if my assessed risk of material misstatement goes up, if my assessed risk of material misstatement goes up, will I want more proximity? Or if the dollar amount of the acceptable difference calculated is based on materiality, which is the right answer that you think? If my RMM goes up, if my RMM goes up, if my perceived risk goes up, automatically I will close down and I will reduce the border between anticipated and actual results. Okay, it is directly a directly a function of my assessed risk of material misstatement. Wait, let me first check the answers. Okay, see, the way I have formed the answer for this is, every time when I see a different kind of a graph, which can give you a lot of, I'll give you a rationale for that graph. How do you read this graph? Okay, then I've given you the correct answer, and then I've given you why the other answer choices are incorrect. Each of these, I would want you to read very, very slowly. See, these may be small questions. I don't want to burden you with like 10 questions and 10 exhibits. We will do smaller questions, but we will try to think deep. These are all evaluation level questions, guys. Okay? And you can call it ADA, but actually you are testing on the audit procedures, on the evaluation, so it can club up with a lot of stuff. Okay? I have given you the rationale for the right answers. I have given you the reason why the other three answers or other alternatives are not correct. And I have given you how to interpret this data. I will give you few more questions, especially from the graphs that I feel are not something that most auditors would be comfortable with. Yes, this is not an easy area. Now, the topics that are left are not going to be easy. You've got to slow down and start eliminating the choices. Don't make the right choice. Eliminate the wrong choices. That should be your approach. Okay? So, spend some time. Each of these have been given with a particular perspective. So, go through these in details. But again, try to arrive at the rationale of why we are negating the wrong answers. Okay? That's it from my side today.